This is Alan Bush with ADMIS with the Daily Financial Forecast for Thursday, December 31st. Starting out with the stock index futures, we are seeing a little pressure this morning. This primarily due to the jobless claims report that did come in higher than expected, up 20,000 on the week. Also, we did have the Chicago Purchasing Managers Index coming in on the weak side. So those two reports contributing to the pressure that we are currently seeing in stock index futures this morning. Also, the S&P is right on the border between being positive for the year and negative for 2015. So even if the S&P cash index does close a little bit lower, it still will be a little bit higher on the year. So we're right on the border between positive and negative growth in the S&P 500 cash index. Longer term, though, we do feel that all of the major stock index futures will be higher next year. And our feeling is that the Fed, even though they did raise rates at the December 16th meeting, that interest rates will remain extremely low, and globally, central bank policy remains extremely accommodative, which is conducive to higher equity prices globally next year. Now, moving over to the currency markets, we are seeing the dollar index trading a little bit higher as prospects of Fed rate increases next year continue. Also, we are seeing the pound trading a little bit lower on the belief that the Bank of England will be rather slow to raise interest rates. So interest rate differentials a bit on the negative side for the British pound, and also the yen trading in a rather narrow range today with a public holiday today in Japan. Now, moving over to the interest rate futures markets, we are seeing a little strength today. This primarily due to the two reports that we had, jobless claims coming in higher than expected, Chicago Purchasing Managers Index coming in weak. So those two reports suggesting a weaker economy, and that's supportive to the credit markets, especially at the longer end of the curve. However, we did have just yesterday the 30-year bonds trading at a 6-week low on ideas that core inflation rates globally are starting to increase. And of course, if the Fed is less accommodative, that would be a bearish influence. So longer term, still looking for lower next year in the 30-year bonds. And this is a trend I think will probably continue well into 2016. So Happy New Year, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.